The stock market crash of 2022 was one of the worst in history, wiping out trillions of dollars of wealth and sending many investors into panic mode. But what caused this massive sell-off, and how did it affect the profits and revenues of major corporations and their employees? One of the main factors behind the crash was the tightening of monetary policy by the Federal Reserve, the central bank of the United States. The Fed had been printing huge amounts of money since the COVID-19 pandemic to support the economy and prevent a collapse. This money flooded the financial markets and boosted asset prices, especially stocks. However, as the economy recovered from the pandemic, inflation started to rise rapidly, eroding the purchasing power of consumers and businesses. The Fed decided to reduce its money printing and raise interest rates to fight inflation and prevent overheating. This move shocked the markets, which had become addicted to cheap money and easy credit. As the Fed reduced its balance sheet and raised interest rates, stocks became less attractive compared to bonds and other assets. Investors started to sell their stocks and move their money elsewhere, triggering a domino effect that spread across the globe. The Nasdaq Composite, which includes many high-growth technology companies, was hit the hardest, losing 33.1% of its value in 2022. The Russell 2000, which tracks small-cap stocks, also suffered a 21.6% decline. The S&P 500, which represents the broader market, fell 19.4%, its worst performance since 2008. The stock market crash had a severe impact on the profits and revenues of major corporations, especially those that relied on consumer spending, innovation, and global trade. Many companies saw their sales slump as demand dried up and costs soared due to inflation and supply chain disruptions. Some sectors, such as travel, hospitality, entertainment, and retail, were hit harder than others. The crash also affected the compensation of corporate executives, who often receive a large portion of their pay in stock options or bonuses tied to stock performance. According to a report by Equilar, a compensation research firm, CEO pay packages at S&P 500 companies fell by an average of 12% in 2022 compared to 2021. Some CEOs saw their pay cut by more than half. The crash also led to layoffs and pay cuts for many workers across different industries. According to the Bureau of Labor Statistics, the unemployment rate rose from 3.9% in December 2021 to 6.2% in December 2022. The number of people who lost their jobs or had their hours reduced due to economic reasons increased by 4.5 million over the same period. Many workers also faced wage stagnation or erosion due to inflation. The stock market crash of 2022 was a painful reminder of the risks and uncertainties that investors and businesses face in a complex and interconnected world. It also exposed the fragility of an economy that depends on excessive debt and monetary stimulus. The crash may have been a wake-up call for policymakers and market participants to rethink their strategies and priorities for a more sustainable and resilient future. The year 2022 was a tough one for many businesses and workers, as the global economy faced a severe slowdown and a stock market crash. Many companies had to cut costs, lay off employees, and brace for a potential recession. In this context, some of the best-known and highest-paid CEOs in America took pay cuts ranging from 6% to 30% in 2022 as a show of solidarity or under pressure from shareholders. One of them was Apple CEO Tim Cook, who voluntarily reduced his annual target salary by 40%, bringing it down to $49 million for 2023. Cook requested the pay cut himself, after a shareholder advisory firm urged investors to vote against his nearly $100 million pay package in 2022. The SEC filing that disclosed the pay cut said it was done in response to concern over Cook's total annual compensation and his support for changes. Another CEO who took a significant pay cut was Goldman Sachs CEO David Solomon, whose salary dropped by 30% to $25 million in 2022. Solomon's base salary remained unchanged at $2 million, but his annual variable compensation fell from $33 million to $23 million. The pay cut came after Goldman Sachs laid off 3,200 employees earlier this month amid a downturn in Wall Street dealmaking. The bank's profit also plunged by 49% last year as advisory fees declined. Zoom CEO Eric Yuan also decided to slash his own pay by 98% in 2023 and forego his corporate bonus. Yuan wrote in a memo to staffers that he wanted to show accountability not just in words but in his own actions. The memo also announced that Zoom would lay off 15% of its employees, or about 1,300 staffers, as the video communications company faced increased competition and lower demand. Yuan said he was accountable for these mistakes and the actions taken today. Intel CEO Pat Gelsinger also agreed to take a 25% pay reduction this year as part of an effort to cut costs at the company. Gelsinger's salary cut was joined by other top executives at Intel, who also saw their salaries reduced by 5% to 15%. Intel said these changes were designed to impact the executive population more significantly and help support the investments and workforce needed to accelerate its transformation and achieve its long-term strategy. Other CEOs who took pay cuts in 2022 include GE's Larry Culp, who saw his compensation fall by $14.5 million or 64% after agreeing to a lower annual stock award, and NVIDIA's Jensen Huang, who took home $21.35 million or $2.5 million less than the previous year after disappointing sales. These pay cuts reflect the challenging economic environment that many companies faced in 2022, as well as the growing scrutiny and pressure from shareholders, employees, and regulators over executive compensation. While these CEOs are still earning millions of dollars, their pay cuts could be seen as a gesture of empathy or accountability in times of crisis. Even though CEO pay packages fell sharply in 2022 as the stock market sank, the gap between CEO pay and median employee pay remains high. According to a report from Equilar, an executive compensation research firm, the median corporate leader on the top 100 list of best-paid CEOs made a record $22.3 million in 2022, while the typical full-time worker made about $56,000. That means the average CEO on the list makes 288 times as much as a typical worker. Some CEOs also received more stock awards that could increase their compensation in the future. Stock awards are the largest component of CEO pay packages, and they increased in value by 19.7% to $13.8 million in 2022. These awards were granted at the beginning of the year when there was less economic uncertainty, so they do not reflect the downturn that followed. For example, Kroger CEO Rodney McMullen got a 5.7% pay raise in 2022 with his compensation package up $1 million to $19 million, according to government filings. His stock awards accounted for more than half of his total pay. This trend of rewarding CEOs with more stock awards could create a perverse incentive for them to prioritize short-term gains over long-term value creation. It could also widen the gap between CEO pay and median employee pay even more, especially if the stock market recovers from its slump. Critics of excessive CEO pay argue that it is unfair, inefficient, and demoralizing for workers who struggle to make ends meet while their bosses rake in millions.